Good evening, grade 12. Today we're going to start a new section on inventory valuation. It is in module 10 in your textbook. I'm just going to use the PowerPoint to explain a few concepts to you, and then we'll go straight into some questions from the textbook. What inventory valuation is new for you this year. However, there is some revision that we can do on last year's work, so this will assist with that. Okay, so basically inventory valuation. Inventory, as you know, is trading stock. Okay, so inventory is the main current asset in a business. A business needs the stock of inventory to begin and continue trading. Okay, now the correct valuation of inventory is very important because of the GAAP concept prudence, which states that assets must not be overstated. Okay, which is why when you put inventory on the balance sheet, the value at which we place the inventory at has to be correct, which is why you've always calculated trading stock deficit so that you don't show the inventory at a higher amount than it's supposed to be. So last year we learned about the difference between the perpetual inventory system and the periodic inventory system. Okay? The perpetual inventory system is the one that we use all the time, the continuous inventory system, which means that every single time a sales transaction is recorded, we say debit cost of sales, credit trading stock. And the periodic inventory system is the one, a short section you did last year, where we use the purchases account and the trading account. Okay, so we need to touch on those two systems a little bit, because when you're answering questions on inventory valuation in your exams, you often have to know the difference between perpetual and periodic inventory for theory questions. You also have to know the advantages and the disadvantages between these two systems. Okay, so if you remember, okay, the perpetual inventory system, movements in trading stock are recorded at the point of sale or at the time of purchase. And in the periodic inventory system, cost of sales is calculated only at the end of a specified period by using a calculation. Perpetual requires the use of technology like a barcode scanner or computer system, whereas periodic is more suitable to simple, even manual accounting systems. Okay, perpetual inventory is used in formal business environments with significant stock movement. So if you look at like a big grocery store like Pick and Pay, they're obviously using the perpetual inventory system because stock is changing all the time. And periodic inventory could be used by a street vendor or a house duck shop, where stock can be easily counted, where there's normally just one person running or each owner run. Okay, so in the perpetual inventory system, we use trading stock and cost of sales for most of our calculations. In the periodic system, we use the purchases account and the trading account. Now you may be familiar with those from last year. Okay? But under both systems, at the end of the period, a physical stock count is required. Now in the perpetual system, the stock is counted at year end to determine the trading stock deficit or the surplus. And in the periodic system, stock is counted so that the value of unsold stock can be subtracted in the calculation of cost of sales. So the reason we do a stock count is for two different reasons. However, the stock is still counted in the same way. And once the value is, just to revise a little bit from last year's work, okay, we used to do the cost of sales calculation. And when we started with opening stock, we would add purchases, less the returns, add carriage on purchases, add customs duty, and subtract closing stock to give us cost of sales. Now this calculation is going to be very important in this section. The reason is that in this section, when we're doing our actual calculations, the actual work, we'll be doing it on the periodic inventory system and not on the perpetual inventory system. And you should be quite pleased about that, because in the past, they used to use the perpetual inventory system in this section as well. It is much more complex than the periodic inventory system. Okay, so when we're doing, I want you guys to remember that when we're doing this section, our calculations will always be done using the periodic inventory system. So this calculation that's on the screen right now is very important in this section. However, for theory answers, you do need to know the differences between both inventory systems, which is periodic and perpetual. And you'll see that as we're doing some questions. Okay, so what is inventory valuation? I told you earlier that a physical stock count must be done at year end in any business. So at year end, we have to do a physical count where each item of stock is counted and recorded. Once the items are counted, a value is then attached to each item, and the total value of all the items is then shown as inventory on the balance sheet. Now that has to be very accurate. So stock counts are usually audited. So that means at the business year end, okay, they'll employ many people to come in to do the stock count, and an auditor will also be present to ensure that the stock count is being done properly. Okay, so that's one of the internal controls on stock, is that regular stock counts must be done and they must be audited. Okay, so once the inventory is counted, this is where our work now will come in. We're going to be calculating the value of the inventory using one of three methods. So one is the first in, first out method, the weighted average, and the specific identification. Now we're going to have to do a lot of questions on these different methods so that you know each one of them, because in exams you can get just one or two or all three. Often they ask you to do comparisons, etc. So you have to know all of them. Okay, so a business decides on its stock valuation method based on the type of goods sold. So businesses that sell like pretty expensive big items will consider specific identification. More general items would be first in, first out. And high volumes of small items could be weighted average. Like for example, if you're selling balloons. Balloons, you sell hundreds of thousands of them. And they're small, they're inexpensive, and so we would consider something like weighted average. However, if the valuation method is changed, it must be approved by the shareholders and disclosed in the financial statements. Now you will get theory questions where the owner wants to change the valuation method in order to decrease the profit or increase the profit. And those are not the right considerations. The only consideration that should be taken into account is the nature of the stock. Okay. So here's some quick notes on the three systems. First in, first out, which we also call FIFO. Goods which are bought first are sold first. Okay, then so closing stock is valued at the latest purchase price. Okay, then we're going to be using branches to assist with the calculation. You'll see that in questions. The next one is the weighted average method. It's usually used for small items sold at high volumes. Closing stock is valued at an average price, and an important calculation is total amount divided by total quantity. In specific identification, goods are usually big and or expensive. Each item can be identified. So in the video I posted, the lady referred to maybe she said that maybe a store selling surfboards would use the periodic inventory system. And because surfboards are quite big and expensive, and also in a surf shop, they don't keep hundreds of them. They're probably only about 30 in stock at the time. Something like specific identification could be used. Okay, so closing stock is calculated on each specific item. And an important calculation to remember is opening stock plus purchases minus sales is equal to closing stock. Okay, so I'm going to end this video now, and then we're going to start some questions from your textbook. Thank you. Bye.